Today we're analyzing Solventum. This is a spinoff of a 3M. So this is a healthcare side of the 3M business. And over the past, well, basically they only went public. Well, the spinoff only happened like a month ago, and they're already down 30%. They actually came out at like $90 a share, and they dropped down to 60 like right away. Um, Actually, this business is pretty decent. I kind of assume that the reason why it went down is because the people that were holding 3M stock, they got um, they got some stock in this, and they probably didn't know what it was, so they probably ended up selling it right away. But yeah, I think this might be a buying opportunity for the stock. So let's check it out a little bit. And it's $11 billion company in the healthcare space. They basically do a lot of the same stuff that 3M does. They manufacture products, except more for the healthcare space instead of for other things. So let's look at the financials. Now, we don't really have a lot of financials on this company because they are so new, but we can see in the past 3 years, their total revenue was 8.2 billion, and it's been very flat. It's just been sticking around that 8.2 billion, and it's been transferring pretty well into their margins. Their margins have been fairly steady, and their income is well, after taxes is 1.35 billion, and being an $11 billion market cap, that puts their price to earnings ratio at like 9, which is really low and very good to see. For their balance sheet is amazing, way better than 3M. So this is like probably better spinoff than 3M, and their net debt is negative, so that's really awesome to see as well. And what are they doing with their cash flow? Well, okay, their cash flow 1.6 billion, which is even higher than their net income, and they could do whatever they want with that cash flow. It seems as though, well, the last few years they had to pay it to 3M, of course, but they're going to be able to stack that cash. Probably they'll start paying dividends. They might be buying back stock. We'll see what they end up doing with that, but they don't really have a lot of debt to pay off, so they'll be able to pay that to shareholders. Now let's take a closer look at what Solventum actually is. Well, I looked at their events and presentations. So here's a presentation. And they are a global healthcare company with a broad portfolio of solutions. They have 7,300 patents, which is kind of insane, and 7% of 2023. So they're investing in R&D. They've got 1.4 billion in free cash flow for the last 3 years. Their operating segments, they have dental solutions, medical surgical, purification and filtration, and then they do health information systems. So that's not manufacturing. This part is not manufacturing. That's more IT. They get revenue in the US and international. So this is a well-diversified business as well. And yeah, it really seems pretty good. Also, there's more and more old people in the world every single day. So expect this market to grow. They're expecting it to grow by 3 to 5%. And yeah, this is the products that they sell. They sell lots of different like manufactured products. Yeah, a lot more of these products and some other ones as well. Yeah, this is what they think the market's going to grow by, basically 4 to 6% for total. And so probably just a little bit above inflation, which makes a lot of sense to me. And so this was a spinoff of 3M, and this is what they think the advantages are. They think they're going to be able to recruit talent easier. They're going to have more operational agility, meaning they can pivot, and enhanced focus. So they're going to be more focused on the healthcare side with this business, and they're going to be able to use capital allocation specifically for the healthcare stuff. So actually, I don't really have to look at the analyst estimates. I know that they're probably going to do what they did the last couple of years. They're probably going to stay very steady with their revenue, and they're probably going to stay really steady with their income as well. And they might grow by 2 to 6% a year. So we can put that straight into the DCF model. Let's do that. So I put their EPS estimate, their revenue estimate here, buybacks of 0, net debt. They have negative net debt. Doesn't really make much of a difference. The discount rate of 10% because I want a 10% return on all my stocks. Exit multiple of 17, just because it's kind of a low growth business. They do have a lot of patents though, so maybe this should command like a 20 exit multiple being in the healthcare space. But they are low growth, so I have them growing at 2% a year, which I feel like this is like a worst case scenario because they're saying that the market is going to grow by 3 to 5%. So you could maybe make the argument this should be higher. And same with the revenue as well. They've had profit margins of 16% in the past. They might be able to increase these, and their revenue growth will probably be between 2 and 6%. So I feel like this is the low side for Solventum. And if all this plays out, then you're looking at a fair share price of $111 a share if you want a 10% return on the stock. So this model makes Solventum look like a really, really good company to invest in right now. Not quite sure why the price is so suppressed right now, but I'd say if you invested in them today, you'd probably be looking at, man, higher than 14% return. This one's pretty good. I would say maybe, what, like a 17% return? Yeah, actually pretty close to a 17% return over the coming years. I would say that's what you should expect with Solventum. Yeah, and like it seems like a really steady business being in the healthcare industry. So yeah, I think I'll probably end up making a position in this. It's better than a lot of the stocks out there. Let me know what you guys think in the comments. Let me know if I missed anything because it seems like I might have missed something. But if I didn't miss anything, then it seems like a really good stock. So yeah, otherwise, like the video, and I'll see you in the next one.